Well, welcome to today's session here. This is the first one we've done here in the last few weeks, but I think it's timely given everything that's been going on in the world over the last couple of weeks. Today, we're going to focus on some tax planning, some tax saving ideas. But I did want to chat a little bit about what's been going on over the last week and a half or so, getting a few different types of questions. So we'll address a little bit of the economic outlook as well. Before I jump into this, I do encourage, if you have questions, to please type them into the Q&A, which can generally be found. If you're on a laptop, is usually at the bottom of your screen. If you hover at the bottom, it'll come up. Like I said, today I'm going to talk for probably about a half an hour, maybe a little bit longer. It's a little bit of a shorter presentation today. And so again, I really encourage you to ask some questions. I'll try and answer them kind of throughout the session. And then if not, I'll just save them to the end and we'll try to get through as many as we can in general. So with that, we're going to give it a go. So again, the agenda today, again, brief comments on the economy, and then we're going to talk about 3 different tax ideas for you. So one is how to reduce tax on interest income by half. The second one we're going to talk about is how to donate stocks to cut your tax bill. I'll provide an example. This is both relevant prior to the end of the year, which would help with your tax situation for this year, but it would also be something that you could do or have discussions about from an estate point of view. And then the last one, I want to talk a little bit about the covered call strategy. I did a session with Asset Canada TV recently with 2 other peers. I did an educational video. It was about an hour long, and we talked about the covered call strategy. So I will comment about this a little bit as well, the pros and cons of it, and whether it makes sense for maybe some of you on this call to be looking at. So with that, we'll jump right into it. This is always one of my favorite sayings in our investment industry, and again, I think it's timely and both relevant. We can't direct the wind, but we can adjust the sails. I think this is critical. We get so much information on a regular basis, and things move at such a quick pace today. Again, we can't dictate what happens or what comes out of the mouths of individuals about what goes on in the economy or global economy, but we can obviously adjust as needed. So with that, I'm going to talk about a few things that are top of mind for me, and I've been getting questions about it. The first and foremost one is obviously the government shutdown in the US. What's really interesting is, generally speaking, when we go through these periods of this shutdown in the US, markets generally respond fairly well. And the most recent one before this one occurred under a Trump administration. I wrote about it about 2 weeks ago, back in 2018, and it was one of the longer ones in history, 34 days, almost 5 weeks. And what we saw during that period of time is the S&P 500 actually posted gains over the period. And when we actually look at the long term, when there has been shutdowns in general, the average rate of return has actually been positive. So again, a lot of times this idea of them shutting down is, I think, a little bit more unnerving from a media point of view than it is more so from an actual fundamental point of view. I would anticipate this to go a little bit longer. We now are entering into the 3rd week. There's not really any resolution in sight. Obviously we have 2 very divided parties on what's going to happen here. But overall, based on some of the things that we're seeing in the economy, the markets have responded quite well here in this short period of time. I will chat a little bit about what's happened since last Friday, which has nothing to do with the shutdown, but rather just the rhetoric that's coming out of the US administration. So the second piece that's top of mind for us as well, and I've talked about this before, but it's the concentration risk that we see in the markets. And really, we talk about mostly the Magnificent Seven or the Mag 7 companies, which are generally made up of companies like Apple, Amazon, Meta, Microsoft, and so on. And what we've seen over the last, 2 decades or so are the percentage of these companies that represent the S&P 500. And in general, what we recognize is that there's always top-heavy kind of concentration risk within the S&P 500. You can go back, 10, 20, 30, 40 years. The difference back then was the companies generally were more diverse. What we're seeing right now is the largest companies in the world that actually drive these returns, they're all in the growth sector. Okay, a lot of them have their hands in from technology and innovation with AI and so on. And so why that's a little bit problematic is we're starting to see them really drive the returns of these markets. So the S&P 500 today is almost 35, almost 40% with the top 10 holdings. Historically speaking, it was generally closer to 20 to 25%. It's a little bit top heavy. And then when you look at the top 10 holdings in the NASDAQ, which the majority of them are the Mag 7s, is close to 60% today is made up of those companies. So I think it's really important to be mindful of this when we're looking at returns of the broad market and how much those handful of companies really drive those returns. And when we actually look at, and this is a little blurry, I apologize, but the contribution of the Mag 7 companies in respect to the total return of the S&P 500, what's interesting is if you actually look at where we are year to date, and again, this is more revised, but 50 to 60% of the return on the S&P 500 comes from those 7 companies, okay? Which means the other 493 companies that make up the S&P 500 account for the rest of roughly 40% of the return. And if you go back to 2023 and 24, it was actually much higher. It was actually over 60%. So again, when we look at the general performance of some of these markets, it's really just top heavy with some of these names that we're familiar with. So when we're talking about, or when people are asking, hey, are we in a bubble? What's our concern? If you're owning only these companies, you've likely had some wind at your back over the last couple of years. But when we see a contraction like we did in 2022, some of these companies we could see fall between 30, 40, 50%, not because they're not good quality companies, but rather because it's just they're just concentrated and they've just gone up by so much. And then the last piece I want to talk about, I'm going to actually tie this in. A lot of folks on this call do not own cryptocurrency, or maybe you do, but outside of us. But I wanted to talk a little bit about what transpired back on a week ago on Friday, and the result not only in the markets, but more specifically about how the velocity of the volatility happens. And I'll specifically talk about this crypto flash. So it's Trump came out last week. Obviously talked a little bit about China and his disappointment with them. And what he was talking about was their restrictions on rare earth metals and so on. And basically what he floated was the idea of actually putting a larger tariff on China, upwards of 100%, okay? In a very short period of time, we basically saw equities, so the S&P 500, NASDAQ, and so on, they contracted. They posted, declines of 2-3% for the day. But when we look at the cryptocurrency market, it actually had a much more significant effect. And I talk about FOMO, or fear of missing out. And that's generally what happens. There's been so much talk with some of these asset classes, including cryptocurrency, with the gains. A lot of folks are asking questions saying, hey, should I be buying it? Because we're seeing the growth. And so I use crypto as an asset class as this example, but this could apply to a lot of other investments where we've seen this type of growth over the short term. So last week, when Trump actually made the announcement, you look at the two bigger cryptocurrencies with Bitcoin and Ethereum fell almost 20% in a matter of minutes, and Bitcoin fell as much as 10% in a very short period of time. Now, that was specifically on that day. If you actually go back to where it was hitting kind of its highs, maybe about a week before, it's actually down more than what you're seeing on this graph. So this goes back to what I was saying. The velocity of volatility can happen at a quick pace, and it makes sense because, and I was using this example earlier, back 10, 20, 30 years ago when we didn't have the data at our fingertips, generally when you had negative news, you would hear it on the radio or what have you, you would go home and see it on the news, but you couldn't process a trade until you spoke to your advisor, your broker, what have you, the next day. So there was, in a sense, a cooling off period. Well, what happens today is when we see news like this, that's a little bit jarring or it's more emotional, we can actually pick up our phone and process trades immediately. There is no cooling off period. And because of that, we actually see the, velocity happen at a much quicker pace here in the markets. Now, I'm talking about the downward trend with crypto in this example, but it also happens on the upside. And so we saw that earlier this year when Trump came out and said, hey, we're going to delay tariffs. I think it was in April or so. And on that one day, some of the markets had the best day ever. We saw significant gains in a very short period of time. So it's really difficult for you to try and plan for these odd days that are up and down significantly. So the best way to manage it is through diversification. And so what I talk about here is, people have been asking me more and more in the last week or two since these comments have come out, hey, do we have potential storm clouds on the horizon? Are we positioned well if we start to see a contraction? I think it's top of mind. And what we have to remember, a couple of things before I go into these points, the media sensationalizes a lot of things. They recognize that negative media, negative stories, they sell. And I talked about this last week in my commentary about the October effect. When I use the example of, shark attacks as an example, if you're on vacation with your family and you happen to read about one and you're at a beach, you might think twice about going into the water that day because it's just so dramatic. But the reality are hippos or hippopotamuses, they actually result in 10 times the amount of individuals that are killed on an annual basis than sharks. But you never hear about those. They're not as exciting as obviously what you see with a shark attack. So it's the same thing is true with negative news. And they've done studies. They recognize that negative news stories has a disproportionate upside in terms of media sales or magazine that are sold in comparison to positive news. So negative news, we know, sells at a quicker rate than positive news. So that being said, here are the 4 points that are top of mind for us. Obviously, we've been talking a lot about monetary easing, which means, Canadian or Bank of Canada and the US Fed will likely continue to cut. We do believe the US Fed will continue to cut another couple times by the end of the year and into next year. And we think Canada will probably cut 1 or 2 more times. Okay. That being said, we are seeing inflation be a little bit more sticky because of the tariffs. And we are starting to see that in some of the economic data. So because of that, there is always a chance that the US Fed will pause rates and perhaps even raise them. But we think that latter point is very is not very likely. Okay. The second one is market concentration. I already mentioned this. Again, the current rally has been disproportionately driven by a handful of mega cap stocks, mostly in the AI sectors. The third one, geopolitical instability. Obviously, we've had some progress in the Middle East. Hopefully that holds. That was positive, I think, just in general, the general outlook with the tensions, obviously, what was going on there. But in general, when you look at US-China, that is still top of mind. It is affecting the markets because, again, if there are additional tariffs, it brings it to the forefront. We could see a little bit of contraction. But if we do see that, keep in mind, this is a short-term, I think, blip. If we go back, we've had a very good last few months. And so a little bit of contraction would not be a surprise at this state of the markets. But again, we think corporate earnings, monetary easing, and so on will be fairly stable for the next couple months. And then the last one is consumer weakness. You'll actually see in my commentary tomorrow, I'm talking a little bit about consumer sentiment and the holiday sales and what we think is going to happen. So I won't give it all away. But right now, the consumer in the US especially, and even in Canada, has been really resilient. We anticipate them to continue to spend, obviously, despite some of the headwinds moving into the holiday season. We anticipate them to continue to kind of support the economy and likely keep us on some stable footing between now and the end of the year. So that's kind of in a nutshell. Again, I spent, the last, 10 minutes or so. So we're going to jump into these tax ideas. If you have questions, again, please put them in the comments section. I do have a few of them coming in now, but again, or if not, just email me directly and we'll get back to you. All right. So how to be tax efficient, folks. So for those of you that have worked with us for a number of years, we've always stressed it's not just the return or the performance of the portfolio, but how much you get to keep in your pocket. So we always try to be mindful about that and how we structure things. For some of you, these will be a refresher because we're already doing this for others. This might be new to you. So before we get into the tax pieces, the tax savings, we have to understand how investment income is taxed. I've used this slide multiple times over the last couple of years. There's a couple different sources of investment income that you would receive. There's interest income, there's dividends, and there's capital gains. And then there's something I'm going to talk about today, which is called return of capital, which is taxed very similar to capital gains. So when you look at the three different, the main sources of distributions that you would receive or gains on the investment side, interest income is actually taxed at the worst. So in this example, if you were to receive $100,000 of interest income, so when you invest in a GIC, or what have you, or maybe you have a rental property or a number of rental properties, that rental income is treated not as interest income, but as taxed the same as interest income, which means every dollar you receive, you pay at your marginal tax rate. So in this example, top marginal tax rate in BC is 53.5%. So if you were to receive $100,000 and you're in that tax bracket, you would actually pay to the government $53,500 on your tax return, and you would be left in your pocket with $46,500. That's what you keep, less than 50% of the interest income that you receive. Okay. Now, capital gains on the far right side here, capital gains, they're actually taxed at the lowest currently. And I know there was some talk about a year ago about changing the inclusion rate above 250 and below 250. But as we learned that was rolled back, that isn't on the table at this point. So we revert back to the original capital gain tax. And how that works, it's 50% of the gains. So as an example, if you make $100,000 in capital gains and you sell, or it's a distribution, of the $100,000 gain, only $50,000 is taxed. And at your marginal tax rate, basically cuts it in half. It's the equivalent of losing roughly 27%. And so if you make $100,000 of capital gain income, you actually in your pocket get to keep $73,250. Okay. Now dividends are kind of in between. So dividends, that get paid out from, your utilities, your financial companies, and so on and so forth, they're actually taxed a little bit differently. And like I said, they fall kind of in between. So ideally in your non-registered accounts, you would like to, if possible, own eligible dividends or dividend producing investments, and investments that actually distribute capital gains or return of capital. Return of capital, again, are treated as a capital gain as well. Actually, it's even a little bit better because you don't pay tax in the year you receive a return of capital, but rather later when you actually sell the investment. And I'll talk about this in 1 second. So what is return of capital? 4 things. So let's walk through it. Tax efficiency. So unlike interest, dividends, and capital gains, income that is classified as a return of capital is not taxable in the year it is received. So if you have T-slips, the tax slips that you receive, okay, you usually give those to the accountant, or if you file yourself, you're going to put all the various income in the different boxes. One of those income that you receive is called return of capital. Okay, so the Foresight private real estate investment, the majority of the distribution you receive on that is return of capital. So when you receive it as an investor, you do not pay tax on it. What happens is your book value gets adjusted, and in the future, when you sell it, you're going to actually pay the difference in the tax at that point. Okay, so if you receive $100 or $1,000 of return of capital today, you keep it in your pocket today. You do not pay any tax. And again, when you sell the investment at a later date, that $1,000 is accounted for. Okay, that's number 1. Number 2, cash flow stability. So again, investments that distribute ROC or return of capital are appealing if you are seeking regular cash flow. And I'm going to give you an example in just 2 or 3 more slides. Number 3, tax deferral. Tax payments can be deferred until the investment is sold, therefore allowing you to keep that money, the tax portion of that money, in your pocket to continue to work for you until you sell in the future. And the last one, I think this one's kind of cool actually, is the ability to utilize capital losses. Okay? And let me give you an example. If you receive interest income or you receive dividend income, you cannot deduct realized capital losses against those 2 forms of income. Okay. The only thing you can deduct your realized capital losses against is realized capital gains. So the benefit of return of capital, it allows you in the future when you sell that investment, if you happen to have any capital losses, whether they're carried forward or triggered in that given year, you can actually offset the capital gain from this return of capital in that given year. So essentially, it allows you to take advantage of some of this tax planning. All right, so again, opportunity costs. I've already kind of talked about this, but I thought a good visual would be ideal. So when you go from left to right, return of capital for the purpose of accounting is deemed to be a return of a portion of your original capital. Okay. Now you might think, well, that's not great. I'm giving money, I'm investing money, and they're just giving it back. Well, that's not quite what the case is, because what happens is, from an accounting point of view, the only way that you can actually defer the tax on that and on that distribution is if it comes back as a form of your original investment. And the accounting mechanism is to adjust your book value, what you paid for that investment, that will be triggered when you sell. Again, a return of capital allows you to keep that money in your pocket today and defer the tax till a later date. Okay. So here's just looking at the growth between return of capital, dividend paying investments, and interest paying investments. So assuming you're making 6% on $1,000 or $100,000 on a 25-year time horizon, everything else is the same. The only difference is how your distribution is taxed. Between the three over a 25-year period, your return of capital is worth a significantly more amount after tax than what you receive on a dividend distribution versus an interest distribution. And what's interesting on the interest and dividend, you can see, your distribution goes up and then there's a little bit of a step down, and it does this for both. That's because you're paying tax along the way. So you earn the income, you pay a little tax. You earn the income, you pay a little tax. Whereas when you look at the return of capital, in the majority, you're basically earning it throughout. And then at the end, this is where you actually pay the tax. Okay. Because you sell it and you realize it as a capital gain. Okay. So you might say, well, what kind of investments can I use with this? Well, there are some ETFs, maybe some stocks, maybe real estate investments that actually distribute income in the form of a return of capital. In cases where it's, say, an interest-bearing investment with the underlying holding, say it's a bond investment, generally that would be interest income. But if it's structured a specific way, they can distribute a return of capital, hence turning interest income into capital gains. So there's a couple different strategies or a couple different structures where a return of capital makes sense and that they distribute. So not every type of or one category of investment. It's generally the type of structure of investment that allows you to be able to do this. And then from a tax efficient, I talked about cash flow. Okay. And here's a really good example. So on an interest paying investment, if you invest $500,000, $500,000, and you do this on an interest paying, a dividend paying, and then what this one here is an investment. It's called a corporate class investment through an institution. But again, it doesn't matter. It's return of capital. If you were to receive 6%, that's $2,500 a month. Okay. So for you to actually put that in your pocket of $2,500 a month, you actually have to earn roughly $4,600 pre-tax to generate $2,500. So you would actually need to earn roughly an 11% rate of return in interest to generate this amount at the end of the day. Okay. Dividend, you would need to earn roughly 8.5%. Okay. To generate a gross amount of $3,500 to net out $2,500. Well, again, back to return of capital, because you don't pay tax until the future, you just need to earn 6%. There's no tax in the year that you received it. And the amount, again, the amount you earn and the amount that you're looking to try and generate from a cash flow perspective is the same. So again, from a risk point of view, you can invest in things that have a lower volatility because you're only looking to try and achieve 6% versus needing to invest in things that are actually earning 11%. Okay. So that's number one. Number two, donating of securities. Okay. So really there's a number of reasons to donate securities, but really it's the reduced taxes is the biggest one. You donate, you reduce taxes by getting a receipt. And then for a lot of people, it also makes an impact with the dollars that they're using. So I'm not going to actually dive into this a significant amount, but I will talk a little bit about the benefits of it and then also show you an example here. So 4 things, donating stocks. So federally, there are 2 levels of tax credits that apply to donors based on your taxable income and the amount of the donation. So in the first 200, it's about 50% of the tax credit. And then on the amounts above 200, there's an additional 29%. And if you're above the highest tax bracket, it even goes up further. Okay. So if we actually look at donating a security in kind, a lot of folks, when they look at donating an investment, a lot of times they'll sell it. So let's say you had an investment that was valued at $50,000, you bought it for $10,000. So there's a gain on it. So what happens, people might sell it. They're going to personally have to pay that tax. But then when they actually contribute it, they're going to get a tax credit to reduce it. Okay. Now the tax is still paid. In this case, based on the inclusion rate, this was an example at 46%. The tax on this gain was $9,200. So at the end of the day, the cost to do the donation, to do a $50,000 donation, net cost would have cost the individual $36,200. Okay. So the difference between that and 50,000 is the tax benefit. Well, if you take the exact same type of investment, but you donate it in kind instead, meaning there's a form that you can just say, I'd like to actually move this off my books onto the charity's books. Okay, you sign the form. You can donate that whole $50,000 security in kind. Okay. And when it's done in kind, there's no tax to you immediately. There's actually no tax to you at all. Okay. And now when you make the full contribution of 50,000, you get the full tax credit, no different than what you did before. But because there's no tax, the net cost to you is actually only $27,000. So like I said, by donating shares, we see this a lot at the end of the year. So people are saying, hey, how can I manage my tax situation? How can I reduce my taxes in this year? For those of you that are looking to maybe make an impact, or like I said, you're driven by saving tax, donating securities in kind can have a fairly significant impact. So again, we have this often in the latter part of the year. So again, if this is something that you say, yeah, this is something I'd like to maybe look at, then let us know. This is one way of reducing taxes. There's other ways, like a flow-through share or what have you. But the problem with flow-through shares, some of you might be asking, I've seen a question come up about it. A flow-through share is an investment in a speculative type company, generally in BC. It's usually mining or resource companies. And you get a benefit of making that investment. But the problem is the underlying company, a lot of the times you could lose your money or you have a significant decline in that investment. But again, the tax savings usually outweighs it. But what we've found since 0809, they're not generally that well received anymore, because again, your upside isn't as beneficial as what it was in the past. So again, this donating of securities is something that, again, folks have been doing a lot more recently. All right. I had a question come in. I'm going to take a pause here to give everybody, again, lots of info. Somebody asked, will there be a recording of this? There will be a recording. Will likely come out in the next few days. It is a lot of info. Really, the purpose of this is to educate folks to say, hey, there are ways to defer tax. For a lot of folks, they've never heard of it before. And so what we want to do is actually share these ideas, even if it's a lot of info, to get you thinking about, hey, there's other ways I can generate returns and keep more in my pocket, not by taking more risk, but just by understanding the Tax Act. So, all right, I'm going to, again, talk about this. I have a few slides. I don't want to make this super complicated, but I think it's kind of a cool idea, depending on what you want to accomplish. Okay. So this covered call strategy, how it used to work is, if I happen to have a basket of stocks, so let's say Microsoft 20 years ago or 10 years ago, I could actually write an option on that, okay, and generate some extra premium. And don't worry about understanding it specifically. I'm going to actually walk through something in a minute. So what would happen is I would sell an option. I would sell the right to actually, for somebody to buy my Microsoft shares in the future, okay? And for that option, people would give me money for that opportunity in the future, okay? So the buyer of that option would own the right to buy a stock in the future at a specified price, okay? Now, if my stock never gets to that price, the option expires and I get to keep the premium. And so you might say, oh, this sounds pretty good. Well, it is pretty good, but the problem is it's very cumbersome. And the reason we don't see it a lot is because it's difficult to write a lot of options for most of Canadian investors to be doing this type of strategy on their own or even through a broker. So what's happened, there's been a boom of what we call ETFs, or exchange traded funds, okay, which a lot of people on this call likely own one or two to gain access to things like the S&P 500, NASDAQ, or what have you. But now what we're starting to see is these covered call strategies offered in an ETF, where a manager actually does all this behind the scenes, but the investors can take advantage of it. Okay. So how does this strategy work? All right. So let's just say your stock is worth, I don't know, 38 bucks, $38, $40, doesn't matter. It's what's called out of the money. You generally would write options when your stock is trading below a strike price. Okay. So if this case, the call option was $44, it means the amount that the share is trading below the strike price, the option is worthless because nobody's going to want to buy your stock at $44 when they can just go buy it at the market at 38 or 40 or what have you. When it's above the strike price, when it's above $44 in this case, then that means they're in the money because if the stock is trading at $48, they've bought the right to buy it from you for 44, so they make the spread. Okay, so I'm going to give you an example here. So there's a couple of different outcomes, lots of info on here, guys. So don't worry about trying to read it all at once. I'll walk through each scenario here, and I'll just go left to right and try and make this digestible. So you own a company, okay? That's trading at $38. So for all intents and purposes, let's call it Microsoft, okay? Now, a manager, now you wouldn't do this, but a manager that is running a strategy like this, they may write an option on this, a Microsoft, at a strike price of $44, which I just explained before, okay? So if that stock goes from $38 to $40, I taught you in the previous slide, that's what we call out of the money, which means the buyer of this option will not exercise it because, again, they can buy it for $40 versus $44. So what does that mean? So if you were owning it, the stock price goes from 38 to 40. So the investor would make $200. But if the premium costs $2 to write and they collected $200 on that, they would actually make an additional $200 on that gain on that share. Okay. Don't worry about the actual numbers to say, is it a good outcome? Is it a bad outcome? It's only $400. Again, if you multiply this by 10 or 20 or what have you, obviously the gains are proportionally greater. Okay. But that's what happens if the share price doesn't get to the strike price. Okay. Now, scenario 2. All right. So stock company trading at $38, it rises to $45. So now it's above, it's in the money. Again, I taught you that in the previous slide. So now the strike price, the 44, the person that bought the option can now buy Microsoft that's trading at $45 for $44. So they're actually getting a little bit of a bargain. Okay. Now this is what's called an in the money option. And now what's going to happen is that buyer is going to actually want to buy the stock. So it's going to be sold to them. Okay. So what happens if you own the stock or the manager owns the stock? The stock would have started at 38. They would have been capped at 44. So it caps your upside. So they get to keep that. Okay. They make $600 plus the $200. So now the manager makes $800. Okay. And they've given up the extra $100 of growth to the new person that's taken over the stock. So essentially it caps your upside. That's one of the drawbacks. Because as we're in a period of time where markets are going up or a stock is going up, the benefit is you get extra income. The drawback is you cap the upside on this, depending on how the option is written. Okay. Now, scenario 3, we look at it if it goes the opposite way. Purchase price or the share price is at $38, but it goes down to $30. Okay. So this is the same thing. This is out of the money because the strike price is $44. So the person's not going to buy it from you or buy it from the manager because they can just buy it at $30 on the market. So the owner of this stock, the stock price has gone down. So they're on the hook for the loss because they're owning it. So there's been a decline of $800 when you actually look at the share price based on 100. But they've been able to actually collect a premium of $200 by selling this option. So now the drawback has been cushioned by $200. Okay. Now, again, a lot of info to go through with this. So the general vibe of this option strategy is if the stock is never exchanged between the buyer and seller, then you get the additional premium. The investor gets the additional premium. So it generates additional cash flow. Okay. If the share price goes down, well, it's no different if you just own it personally. But if you have an option that's out of the money, you at least collect the option, the premium that offsets a little bit of the downside. So it reduces the downside, even though you're still participating on it. And if the share price goes up and it's in the money, so it's greater than the strike price, the drawback is you actually limit your upside. Okay. So are these strategies, do they make sense in every market? The answer is no. If we're in a period of where we see a rapid expansion and the market's going up, I would likely suggest to our investors is let's just own that individual stock, okay, or own an ETF where we benefit or participate on the upside. But if we happen to have, an individual, maybe they've had GICs or they're trying to generate income, and beyond just owning a basket of dividend-paying stocks, we might say, hey, here's an opportunity to diversify not only that part of your portfolio, but as a way to generate some additional income through another strategy called the covered call strategy. Okay. So again, the benefits, potential income on the upside, buffers the loss in a stock price decline. But the potential risk, obviously, is it limits the potential gain. And if the loss in the stock exceeds the buffer, then you're on the hook for that. So again, going back to it, I think there is a place for this. The way they're actually structuring it now, the underlying baskets are becoming more broad with the evolution of investment securities that we have access to. But I don't believe it's meant for everybody. I don't personally own covered call strategies because for me personally, I'm not trying to generate income in my stage of life. I'd rather just own the company that I believe in that's going to grow over the next, cycle or what have you. But again, for individuals that are looking to try and supplement income, and I think this is going to happen with Canadian, especially retirees that have become accustomed to making 4 to 5% on GICs over the last 2 to 3 years, as it goes down, they're going to need to augment their income because they're not generating as much, number one. And then number two, with these, again, a lot of the distributions on these types of investments, and I taught you at the beginning, it's not deemed interest income, but it's actually tax preferred income. So now what they're able to do is they're actually able to not only augment income by getting a greater yield, but also keep more money in their pockets. So I think there is a place for this for individuals that are at a stage of life where they're trying to generate some additional income. But again, it's not a cookie cutter approach. It's very specific based on each individual investor. Okay. And I think that's the last piece, guys. So again, I actually gave you 4 ideas on the tax. I talked briefly about flow through shares. So what I'm going to do right now is I'm going to actually just open it up for questions. I do have a few here that have been coming in. If you do have some questions, please actually type it in. Again, I'll spend a few minutes here. I said I'd talk for roughly 35 minutes or so. I went over just a little bit. I'm going to give you a little bit of time back on your afternoon. But I actually do have, a couple of questions. So I see one here that says, do I have any thoughts? And sorry, guys, I'm just looking at my screen to the right here as I look at the questions. Do I have any thoughts or comments about year-end planning, year-end tax planning? So the answer to that is yes. So again, I talked about the ability to donate stocks, charitable giving, but again, some people do it more so because they're trying to generate some tax deductions given their income they've had throughout the year. So that's number one. Number two, for our clients that are on this call, we do a review of our portfolios, and we do look at doing, any tax loss harvesting, where we might rotate from one investment to another investment to create simply a paper loss that can be applied to capital gains that you've earned throughout the year. And by the way, the other thing that's actually nice about this, for those that aren't aware, these capital losses that are paper losses. So let me give you an example really quickly. If you have an own Royal Bank, and let's say you invested $100,000 hypothetically, and for whatever reason, Royal Bank is now worth $95,000. Well, if you simply sold Royal Bank and you were still bullish on the Canadian financial sector, if you sold Royal Bank and bought TD Bank, you're still in the same financial sector. But what you've done now is you've triggered that $5,000 loss. You haven't lost it because your money is still invested, it can still go up, but now you've created a paper loss. That paper loss can actually go and offset your realized capital gains for the year. It can be carried backward a couple of years to offset capital gains you might have had in previous years. And if you don't have any of those, the beauty of it is you can carry them forward indefinitely, which means if you have this $5,000 paper loss and you have a gain in 2 years from now, you can use that against it. So where we've found some planning is, we've had clients that have had some significant tax situations, a year or 2 years ago where they might have sold a property or what have you. And so what we're looking at is we're saying, hey, you might not have a lot of capital gains this year, but you've had capital gains the year before, the year before that. If we do some planning today, you can actually go back and recapture some of the tax that you would have paid, and the government will actually give you a refund on it. So again, sometimes it's not just about today, but it's just about where you are in the cycle. Okay. So again, tax loss harvesting, we'll look at it. Obviously, the last couple of years have been good, so there's not a lot of losses to be harvested, but we still do like for our clients and families, we still do a review of the accounts, and if it's substantial enough, we'll do some trades just to move the portfolio around to create some of those losses for your tax season next year. Okay. I did talk a little bit about interest rates. I see another question here about interest rates, just interest rate policy, specifically is talking about mortgage rates. They're looking at actually acquiring a new mortgage. So yeah, like I said, I think Canada's going to probably cut at least one more time, maybe by the end of the year. I think mortgage rates, could be affected. It's not the only thing that affects mortgage rates is when the Bank of Canada cuts, but it does affect, the variable rates and so on, generally speaking. So if we do get a rate cut, I think we'll see that in the mortgage rates. But I think they're pretty competitive right now. I don't think we're going to see a significant difference between now and the end of the year with interest rates. But again, we recognize that we do have the easing of monetary policy right now. So we anticipate that to continue to continue. The last piece that I had, and that people were asking, hey, we're starting to see a lot in the media. Are we in a bubble? Is a big crash coming, so on and so forth. And the reality is nobody knows. Warren Buffett doesn't know. The US Fed doesn't know. Bank of Canada doesn't know. Nobody has a crystal ball. So our belief, we recognize volatility is here to stay. Some periods it'll be more, some periods it'll be less. But anytime we invest in equity markets, we're going to get up and down. And when you look at a chart over the long run, we see an upward trend more than a downward trend. Okay. So through every cycle, we could go through a contraction, but out of a cycle, we see more prolonged growth. So do I think we're in a bubble? Do I think that we're going to have a big crash? I don't believe so. I mean, could it happen? And anything is possible. But we believe, again, the markets are in somewhat stable footing. Corporate earnings are pretty good. Monetary easing, we think, is going to continue. And again, I talk about corporate earnings. The corporate earnings last quarter was really strong. We think that it'll continue into this quarter. And again, the consumer sentiment is low, but the actual consumer themselves are continuing to spend. We think that's going to happen, obviously, throughout the holidays here. So we believe actually, things should march forward. That being said, the wild card is coming out of the US. If there is, increased, and I wouldn't even say geopolitical in terms of unrest, but rather trade policies and tariffs and so on. So what's happening right now with the government shutdown? We're not getting a lot of that economic data that generally gets released. So no labor reports. So what we only have the private sector to look at to see what's happening with them. The labor market was weakening, prior to the shutdown. We anticipate it to continue to somewhat cool. That being said, Canada posted a gain in their labor market on their recent data. So again, for us, the way to navigate this is we take a broad approach, more diversified approach, own multiple sectors, own multiple geographic regions, and we couple that not just with 2 asset classes, but we go 5 to 6 asset classes beyond the traditional stocks and bonds. And we've actually lived through 2020, 2022, 08 and 09. And despite all those headwinds, our clients and our families have had good experiences. So I don't actually see that changing on a go-forward basis. But if you have questions or comments, you want to chat a little bit more about your portfolio, by all means, drop us a line. We'll touch base with you. We're happy to have that conversation. But I'm not making changes in my portfolio at this time. As a matter of fact, I'm looking for a little bit more opportunities if they're present. But in general, I believe enough to kind of stay put. Okay. With that, I'm going to wrap. Like I said, thank you so much for everybody hanging in there. I see the attendees. We actually had a pretty overwhelming response here today. All of you stuck for the whole session, which is fantastic. If I don't speak with you, I probably won't. Have a great Halloween. Obviously, it's only a couple weeks away, and can't believe I'm saying this, but the holiday season is obviously around the corner once we probably get through mid-November. So by the time we have our next one, holiday season will be just starting. So between now and then, all the best with everybody. If you have questions, obviously don't hesitate to reach out. Take care of yourself. We'll talk to you soon. Bye-bye.